Namaste, welcome to Arthaniti, where we discuss money and money matters to help you in your investing decisions. India's economic momentum is gearing up for a dynamic shift. The Reserve Bank of India's recent rate cuts, government measures to put more money in the hands of people has set the stage for an exciting revival in consumption. As the world's largest population, 1.4 billion of it, we not only represent the largest consumer base but also the biggest growth opportunity globally. As discretionary spending is expected to soar, this is the right time to explore the ever evolving landscape of India's consumption sector. But the consumption story does not start and end with the FMCG sector alone. It spans across automobiles, e commerce, retail, entertainment, luxury goods, and even some services. From Tata Motors and Titan to Reliance Industries and Zomato, India's consumption sector is firing up on all cylinders. Adding to this outlook, the uncertainty surrounding the US tariffs, the geopolitical tensions globally emphasizes the importance of domestic driven investments for stability and growth. Today, instead of focusing on any individual consumption stock, we will focus our attention on consumption funds and why they are a smarter investment option in the current scenario. With professional management, superior diversification, multi sector exposure, consumption fund allows investors to capture opportunities in India's booming consumer economy while mitigating risks. On the 9th of April, RBI delivered a second repo rate cut, reducing the benchmark rate by 25 basis points to reach 6% from 6.25. Now, prior to this, it had reduced rates in February, which was the first time in 5 years that RBI had taken such a rate reduction decision. Now, it is also interesting to note that RBI's stance has pivoted from neutral to accommodating, signaling a willingness to further rate reduction and stimulating economic growth. Governor Sanjay Malhotra emphasized that this change in stance is particularly positive for the Indian economy. He also said that going forward, there are only two options, either maintain these current rates or reduce them further. Now, the timing of these policy adjustments is also particularly significant. Indian auto, steel, aluminium are already facing 25% tariffs. There is no pause on that. Plus, the base 10% tariff is also in place. Given the uncertainty surrounding the pause on the 26% tariff that the US proposes to impose on India for 90 days, the stance by the RBI is very, very important. Economic projections have been revised downwards. Now, the RBI has lowered the GDP growth forecast for the current fiscal to 6.5 from the previously projected 6.7. Industry experts believe that this accommodative policy will help cushion India's economy against external shocks while simultaneously boosting domestic growth. The rate cuts directly translate relief for home, auto, and corporate loan borrowers. CII Director Chandrajit Banerjee noted RBI's accommodative monetary policy combined with government's growth centric fiscal policy will help boost domestic growth amidst global economic turmoil. Now, in simple terms, what this means is for average consumer, their EMIs are going to be lower and their purchasing power is going to increase. Housing finance represents one of the most immediate beneficiaries of this policy shift. Now, real estate experts suggest that the rate reduction will boost demand, particularly amongst first time buyers and those targeting affordable housing solutions. Anuj Puri, chairman of Anarok Group, suggests that if banks do pass on the benefits of the two rate cuts, it will boost home buyers. Many first time buyers who were hesitant to take the plunge will now move if home loan rates are reduced. The confluence of lower interest rates, targeted fiscal policy, and evolving consumer behavior represents a compelling opportunity for consumption focused investments. But rather than focusing on any one consumer stock, it is prudent and smart to focus on consumption fund. Why am I saying this? What are the reasons? Well, there are several reasons. To name a few, firstly, funds offer superior diversification in a volatile sector. Now, there are various subsectors in the consumer economy, from staples to discretionary, from luxury to services. Funds help us invest across these sectors and reduce the risk of investing in any one particular consumer sector. Correct? Take, for example, the case of Nippon India Consumption Fund, which invests 80% of its assets in companies that benefit directly or indirectly from domestic consumption led demand. It helps your investments to be professionally managed by people who have sectoral expertise. It also helps mitigate risk, as I have already explained, and it aligns well with the current government policies. Some of the top performing consumption driven funds in India, well, to start with, SBI Consumption Opportunities Fund. Now, this fund was founded in 1999. It boasts a AUM of nearly 2,700 crores. The returns for 1 year stand at 6%, 3 years at 15, and for 5 years the returns have been 29%. Expense ratio of this fund is at 1.04. If you check the portfolio composition of this fund, the top holdings are Asian Paints of nearly 7%, Bajaj Finance 6%, Titan also 6%. Sectoral bifurcation of the fund: FMCG has a weightage of 32, consumer durables 22, automobiles 18. Now, the fund emphasizes on large cap stability with nearly 70% allocation while maintaining 20% mid cap exposure for growth. Nippon India Consumption Fund, which was incorporated in 2004, has an AUM of nearly 2,100 crores. Its 1 year returns stand at 5.85, 3 years at 17.70, and 5 years at nearly 28%. Expense ratio is lower than SBI consumption, standing at 0.58. Portfolio consumption: it holds Tata Motors nearly 7.2%, Varun Beverages, Zomato. Sectoral bifurcation in the fund: well, automobile has weightage of 28%, retail 24, and food and beverages has a weightage of nearly 19%. The fund allocates 15% to small caps like Sapphire Foods and Devayani International for aggressive growth. ICICI Prudential Bharat Consumption Fund, which was incorporated in 2019, so relatively new, has a AUM of 2,500 crores. Its return for the last 1 year stand at 4.89, 3 years 14.23, and for 5 years 23.68. Expense ratio is the lowest of the three, standing at 0.57%. Checking the portfolio composition, its top holdings are Reliance Industries, nearly 9%, Titan, ITC. Sectoral bifurcation in the fund: well, FMCG has a weightage of 35%, retail 24, and consumer durables nearly 16%. The fund balances defensive FMCG stocks with growth oriented retail plays like Trent. Please keep in mind that the three funds that we spoke about are not investment recommendations. It is always advisable that you approach an investment advisor if you want to take the right investing decisions. We took these three funds for educational purposes, to help you understand how these funds bifurcate their assets between various sectors instead of focusing on one sector, and what kind of investments these funds are doing. You must have understood that the past 1 year returns of these funds have been subdued, but the future outlook looks positive with monetary policy tailwinds, where RBI has reduced 50 basis points of benchmark rates in 2025, directly reflecting in reduction of home loan rates from 9.15 to nearly on an average 8.40. Now, this has helped to free up nearly 7,200 crores annually for consumer spending. This could boost discretionary spending by 12 to 15% by financial year 2026. This estimate is as per CRISIL. When it comes to urban demand, the post pandemic savings has created a 4.3 trillion rupee consumption buffer for urban households. For rural households, monsoon predictions are above average. MSP on crop is set to increase from 4 to 7%, which will increase rural incomes by nearly 8 to 10%, boosting rural consumption as well. Consumption funds are pivoting towards new economy stocks. Uh, the sectoral allocation for e-commerce has gone up to 18% from 9% in 2020. Premiumization has also been one of the factors. Now, luxury car sales grew by nearly 22% year on year basis for the quarter one of financial year 2025, benefiting companies like Tata Motors, Mahindra and Mahindra, BMW India, to name a few. Valuations in this sector have also become attractive. Now, in 2024, discretionary consumption stocks had corrected nearly 14%. The Nifty Consumer Index trades currently at a PE of 48 versus its 5 year average of 58. Now, this offers an entry opportunity. The government fiscal support is also improving. The 2025 budget allocated 1.2 trillion rupees for rural infrastructure and production linked incentives for electronic manufacturing. Now, this could directly result in the creation of nearly 45 lakh jobs and boost the demand of this sector. Foreign portfolio investors have invested nearly 12,400 crores in the consumer stocks in the first quarter of 2025. This is the highest since 2021. Now, this signals confidence in the domestic demand story of India. There are various strategic advantages for investing in a consumption fund rather than an individual stock. Now, it helps to mitigate volatility. To give you an example, funds reduce single stock risk. Now, ITC, if we take the case of ITC, the share price dropped nearly 18% in 2024 compared to Nippon's gain of 5.85 for the same period. Correct? Then it gives thematic breadth to the investment. ICICI Fund holds 58 stocks across 15 subsectors versus individual investment typically holding 3 to 5 stocks. Correct? Then actively rebalancing is what happens in actively managed stocks schemes. During 2024 FMCG slowdown, SBI's fund shifted 12% of allocation to auto stocks, gaining 9% alpha. Alpha measures the return of an asset compared to its underlying index, correct? So that is what alpha is. What are the risks that you need to take into consideration? Well, crude is at an all time low, but any increase in crude prices would put margin pressures on paint and FMCG companies, correct? Monsoon variance, right now the prediction is above average monsoon, but what actually transpires only a few months later, we'll be able to understand. So, any what do we say, any variance from what is projected will dent rural demand recovery. Also, the US tariffs and what happens after 90 days, or will Trump revoke the pause before 90 days, the way he has been doing with his decisions, also possess a pressure on what you expect from the geopolitical background in which we operate. Now, while investing in consumption fund, the best strategy would be to opt for a SIP, which helps you with the advantage of rupee cost averaging. Correct? Then the outlook has to be medium to long term, at least 3 to 5 years, and not a short term outlook. Also, diversification within the theme. Now, the fund managers and their investment philosophies differ. It would be visible from the composition, the portfolio composition of the fund, and how assets are invested. What aligns closely with your investment philosophy should be a right choice for you. Current economic environment of reduced benchmark rates, favorable fiscal policy of the government presents a compelling investment opportunity for increased allocation to consumption based investments. Governor Malhotra has also emphasized that the effect of US tariffs on India would be comparatively lesser than that of China. This relative resilience, coupled with the central bank's proactive approach to support growth, positions consumer sector favorable for medium to long term. But again, it is very necessary that you understand where you are putting your money in, be confident about that investment, and seek professional advice from experts to make the right investing decisions. This video was for educational purposes to help you understand what consumption sector future outlook is. What do you think about this video? If you have liked this presentation, please like, share, and subscribe to our channel for more such informative content. Until next time, stay safe and happy investing.